In this video we are going to talk about 20 dividend stocks to buy now. So before starting, please like this video and subscribe to this channel for our future updates. A more stable market in 2021 compared to 2020. After the pandemic shock of last year, the economy is still recovering swiftly. The upswing is driven by job and consumer growth. Despite rising interest rates and inflation fears, the 10-year Treasury bond yield is near 1.5%, a historic low. So high-dividend corporations still outperform low-dividend bonds. Number 20. Kimberly-Clark Corp, KMB. Clothiers Kimberly-Clark. Its products include toilet paper, soap, cleaning materials, diapers, and incontinence things. So far, the 2021 has been calm. Fear of a pandemic caused many individuals to buy excess paper last year, affecting sales. Prices are growing due to inflation. The company's future is promising. A year of nearly unchanged shares makes them a market bargain. Kimberly 3.4 Clarks% dividend yield also attracts to income seekers. Number 19. Newmont Corp, NEM. Newmont is an American gold and metals miner. Economic growth and political support were ideal for gold miners. Rather than gold, it appears that demand shifted to cryptocurrencies. For certain investors, Bitcoin appears to be a safe haven against inflation. Despite this, gold remains near its all-time high of $1,800 per ounce. Despite the stock market's disdain for the business, gold miners thrive. Newmont distributes dividends to shareholders and now yields 3.8%. Number 18. Antero Midstream Corp, AM. Antero Midstream is a riskier company. In Pennsylvania, Ohio, and West Virginia, it is a subsidiary of Antero Resources Corp. Antero Midstream oversees natural gas gathering, compression, processing, water distribution, and blending for its parent company. Antero Midstream yields 8% in 2021. A high yield usually means a cut. But with natural gas prices increasing, that seems unlikely. Gas prices may rise further in the coming weeks, supporting the Antero complex. Number 17. AT&T Inc. AT&T has been the worst dividend stock of 2021. And it had a streaming business. But management failed to deliver and chose to spin off the asset with Discovery Inc. (DISCA). Due to corporate reorganization, AT&T's dividend will be greatly. The corporation will still give a high yield, but it will be less than 8%. Notable omissions: AT&T's stock has fallen, and the corporation is refocusing on phone services. If AT&T can improve, the stock looks inexpensive. Number 16. Crown Castle International Corp, CCI. Crown Castle is also on the list. 40,000 cellular towers, largely in the US, are owned, operated, or leased by AT&T. IL monitors tens of thousands of miles of fiber optic cable. Crown Castle is thus a safer choice than many of its counterparts. REITs tied to malls, retail centers, and offices have recently struggled. And they have a bright future. Everyone now uses smartphone data. The IoT and 5G will intensify this. 40,000 cellular towers create a real estate empire. Crown Castle provides a 3.2% dividend. Number 15. Mondelez International Inc., MDLZ. It's not all about food. For example, Mondelez makes Oreo and Cadbury. During the outbreak, people bought more food, raising 2020 sales. In 2021, the cost inflation pressures have risen. But a food giant like Mondelez may compel price increases and emerge stronger than ever. A bargain, as the shares have only gained modestly. The corporation also pays a 2.3% dividend. Number 14. Cisco Systems Inc., CSCO. This makes Cisco one of the highest-yielding tech stocks. Cisco is now a tech utility. A critical component of the internet is Cisco routers. But most of the tech is already there. Cisco, like many other IT behemoths, doesn't have to spend tens of billions on the metaverse or self-driving cars. Stockholders may thereby receive a big capital return from Cisco. A combination of growth and income stocks can be a good fit at roughly 16 times forward earnings. Number 13. Discover Financial Services, DFS. A high-yield credit card issuer, Discover is one of the lists. In comparison to a savings account, MasterCard Inc. (MA) pays a 0.5% dividend. Discover stock yields 1.7%. The company can raise the dividend because its payout ratio is only 20% of earnings. The opportunity to learn about credit cards is wonderful. During the outbreak, the Fed and the state aided greatly. Discover and its peers have improved profits. Less than 8.8x Discover's anticipated earnings. Number 12. Chevron, NYSE, CVX. Odd to begin with Chevron. Oil is most susceptible in a shifting energy landscape. In fact, many experts believe the oil demand peak has already occurred. Global oil demand will peak in the late 2030s and then begin to decline, OPEC said on Thursday, reflecting the pandemic's long-term impact on the economy and consumer habits. Number 11. Exxon Mobil, NYSE, XOM. Like Exxon Mobil, Chevron believes its best days are behind it. Today's $63.60 pricing is close to the $60 consensus. So there's some hope. Prices are unlikely to decline soon even as they approach $80 per barrel. According to Reuters, the supply deficit will last months. Exxon Mobil, among others, benefit. Caution is advised when purchasing XOM shares. Number 10. Lockheed Martin, NYSE, LMT. Lockheed Martin's core would be lost if we avoided LMT shares altogether. Future growth and competitive advantages. Sales rose 5% overall, with each of the company's 4 business sectors increasing. That's a lot for Lockheed Martin. The average desired price of $378 is slightly higher than today's $342. Also, revenues are predicted to grow 26% in 2022. The estimated revenue is $27.84 billion. Number 9. McDonald's, NYSE, MCD. For 2021, it was over $215 and on many dividends investment lists. As a result, MCD stock increased. Storyline lost appeal as stock price hit $250. MCD stock, despite its 3-year highs, has considerably more to go. A stock price of $267.60 confirms this. That's a 7% gain. Number 8. PepsiCo Inc. PEP. Most people associate food and beverage stocks with Coca-Cola, KO. But PepsiCo is quicker. It's hard to imagine a world without soft drinks in 2020. PepsiCo had a better year thanks to Frito-Lay. Snacking continued during the arduous quarantine period. Analysts at PepsiCo feared inflation in 2021. Price increases are possible due to PepsiCo's great brand recognition. Number 7. Iron Mountain Inc. IRM. Iron Mountain is a data and document storage REIT. Investors feared a reduction in paper usage would affect the company. Management has adapted due to a more digital focus on data backups and data center operations. Iron Mountain stock has risen to new highs in 2021. The company pays a dividend yield of 5.2%. It's partly due to REITs. REITs are immune from double taxation on income, but must distribute at least 90% of earnings to shareholders. Iron Mountain shareholders got a nice deal. Number 6. Johnson & Johnson, J&J. This is a big stock. Each year, the company's income and earnings increase. For this reason, it raises its dividend every year. It is one of the few American dividend kings, or stocks that have increased dividend distribution for at least 50 years. J&J's healthcare company is diverse. The consumer business sells Listerine, Pepcid, and Band-Aids. The firm sells pharmaceuticals and medical devices. Antibiotics are being used to treat the epidemic. Its turnaround in 2021 makes now a great moment to snap up its 2.6% dividend yield. Number 5. Apple, NASDAQ, AAPL. Many are likely unaware that AAPL pays a dividend. Yes, the dividend is rising despite the low 0.59% yield. Apple's dividend has risen by 10.4% annually for 5 years. Apple's dividend of 22 cents may not sound attractive at first. Apple hiked its dividend from 20.5 cents to 22 cents in May, a 7.32% increase. Number 4. JPMorgan Chase Co., JPM. Pandemic investors expected massive loan losses. Instead, the banks sailed. Now it's all up to the banks. Boom time. Crashing markets after that, the Fed will taper and interest rates will likely rise. Investors should consider JP Morgan as one of the best-run big banks. Its 2.4% return may not be spectacular, but the firm's reputation for success is. Number 3. AbbVie Inc. AbbVie. It's a high-yield healthcare stock. Humira is the main source of revenue for AbbVie. It is the best-selling drug in recent years. The patent for Humira expires in a few years. This year, the business acquired rights to other drugs including Botox. Its current yield of 4.8% may be a suitable entry point given its modest 2021 growth. Number 2. Greif Inc. Jeff. The tiny Greif has a big influence. The packaging and container maker is well positioned for 2021. Boxes and other packing materials are in high demand. Greif reported a 38% revenue gain over 2020. Earnings also outperformed. Input expenses have grown. Greif has boosted prices to ease concerns. As a result, Greif expects to gain as Americans spend like never before. Jeff's stock now yields 2.6%. Number 1. Target Corp, ticker, TGT. Target is the list's first and lowest paying option. Currently, shares pay 1.4%. But there are 2 points. First, Target beats the S&P 500. The stock's recent increase has reduced Target's yield. That's not a big deal. A $7 billion digital drive launched in 2017 made the firm more competitive in e-commerce. Target met the pandemic demand for organizations that could manage online food and basic supplies in 2020. Target's quarterly financial performance in 2021 has been exceptional. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.